What does this portfolio have in common with this one? Or this one? The answer, they're about to lose a lot of money. If you've clicked on this video, you're probably worried you might lose money on your crypto investments. Or maybe you already have. I don't judge. But you've come to the right place. I bought my first crypto 11 years ago. I've made over $1 million in profits trading and investing since then, and I've also lost $300,000 in a bad trade before. This video will show you how to fix your portfolio from the inside out. This includes fixing your assumptions, so you're starting with a profitable foundation, all the way to how to allocate your money in and outside of crypto. Let's make your recent mistakes your only mistakes. This is how to unfuck your portfolio. No matter what most crypto investors tell you, they all share one basic assumption. Crypto is their chance to make huge amounts of money quickly with zero effort. And that assumption destroys them. They go into crypto blind with zero plan. They pick cryptos based on hearsay or Twitter conversations. They have no conscious long-term plan for what they're trying to achieve in crypto or with their finances in general. And all this just means their portfolio looks like this. It's exposed to massive risk. So when the market tanks or they fall prey to a crypto scam, they not only lose everything because they had no risk management, but they've also shattered their dreams. The first thing I do is change that assumption to this one. Crypto is a place where I can make great returns with low effort, provided I have kept my level of risk low. That's important. This assumption is built on my favorite money-making rule. If you want to be rich, don't make big losses. It's that simple. Don't lose money. That's rule number one. This is something we stress on FINOVA all the time. Crypto trading is a great way to make money if you understand how to keep your risk low. That's why we have coaches that give step-by-step instructions on all of their trades, from setups all the way to stop losses and taking those profits. This means that members can copy their trades and take on the same low level of risk that gets coaches like Kyle in over 80% win rate across hundreds of trades. FINOVA has helped members rack up profits like this, and this, week after week. To avoid big losses, you need to pick investments through the lens of risk. How much risk is this exposing me to? Am I safe if this goes bad? Will one failure wipe me out completely? If you've lost a lot of money in crypto, failing to ask these questions is why. That's why you lost a lot of money in crypto. Every investment will add or subtract risk to your portfolio. So you better know how much risk you're taking on with each individual investment. Otherwise, you just don't know how your portfolio is going to do. To help myself conceptualize this, I look at risk like this. There's two parts. High risk investments. These are the ones that I only put money into that I'm willing to lose. This would be 99% of crypto. Any meme coins, small caps, mid caps, even large caps fall into this category. And then we have low risk investments. This is the other half of the equation. These are the ones that I only put money into that I'm unwilling to lose. This would be cash, treasury bonds, ETFs, and to some lesser extent, Bitcoin. And as you'll see in this video, these two simple approaches are the keys to fixing your portfolio. Lower risk investments, keep your money safe and growing slowly, but sprinkle in the right amount of higher risk investments and you give your portfolio the ability to grow very, very quickly in the right environment. So you're probably thinking this, how do you balance out these two forms of risk? How do you stay safe but make big wins at the same time? Now remember, this is all just my opinion. I'm not a financial advisor, and I encourage you to do your own research as well. But if I wanted to be safe while making huge wins based on 11 years of experience in crypto and over $1 million in profit, here's how I'd do it. A good portfolio has these fundamentals. Number one, it can't lose a huge amount of money quickly from a big loss. Number two, it can't lose a huge amount of money from lots of small losses. Number three, what it can do is capture huge wins when those wins happen. This means it has exceptional defense that protects your money with pockets of effective offense that rapidly grow your money. And if I know my high risk offense is going to largely come from crypto, then my low risk defense is going to be all outside of crypto. It's a balancing act, and this is crucial. And it's probably where you're going wrong if your portfolio is fucked. Here's how to fix it. If you can make it through the next minute, you can fix your portfolio. Because this first part, you're not gonna wanna hear this, but you need to hear it. First things first, I'd make sure I have 6 to 12 months of my base life costs saved up to cover things like rent, food, utilities, whatever you need, have that saved. That way, if shit hits the fan, I'm safe. The reason I do this and do this first is that if all of your money is tied up in cryptos or other investments and you need emergency cash right now, you're in big trouble and you're going to get a huge financial loss and a bunch of stress. That's not a risk I'm gonna take. Think of your emergency fund as a layer of armor for your life. If you don't have one, go back to square one, lock it down, then come back to investing. Once I have my emergency fund in place, I'd take 20% of my investing budget and keep it as cash. Now, this isn't cash for holidays, new cars, overpriced watches. This is cash I'm keeping for financial agility. This is so important. This is the reason why I've been able to maneuver so many amazing deals in my life, is because I've had cash ready. This means I can buy income producing assets when the opportunity presents itself. So if the market tanks and great stocks are cheap, or a business comes up for sale, a piece of real estate, or even a great crypto project, I have the cash that's ready to seize the opportunity.
Shut up and take my money!
Instead of being tied up in some other place and just sitting on the sidelines like, oh, I know that's gonna make money, but what are you gonna do? I don't like when that happens. Patience is so important in investing. And I mean, look at the biggest investors of all time. They have cash parked for long periods of time. They wait, they're hunters, and then they strike. But they only strike when the opportunity is there, and you just need cash to be able to do that. You need to have that financial agility. Now, this might sound weird, but this is exactly what I did in my late teens. I had about $30,000 in cash saved from my first business, a pool cleaning company. And then an opportunity presented itself. I got the chance to buy a moving company, so I bought it with all of my money. It literally took every single cent. But then within a few years, I made over $1 million from that moving company. And that changed my life forever. It brought me on a trajectory that I would have never been able to hit with the pool cleaning business. And I never would have been able to do that if I didn't have the cash sitting there. So don't ever sleep on cash. You'll thank yourself later. Next, I'd go to the bulk of my defense and put 50% of my investment budget into broad index funds or ETFs, ideally one that just tracks the US stock market. Keep it simple. This is the bread and butter of your portfolio. It'll give you what averages out to a consistent 7 to 10% annual return. A solid layer of armor and historically a very reliable place to keep your money secure and growing at a decent rate. To find it, just search up S&P 500 index fund. There are dozens you can choose from. I have some Vanguard, I have some Schwab, but they all just track the 500 largest public US companies. But wait, there's more. There's another form of defense that I'd want. We're building out a rigorous portfolio, so I'd stick 10% of my portfolio in government bonds or CDs. These are ultra secure, ultra safe, and provide a small but very reliable return that pays off anywhere from 4 months to multiple years, adding even more armor to our portfolio. Right now, I have just under $500,000 in bonds paying me just over 5% interest. And of course, a caveat here, this bond-specific advice might not be good all of the time, but right now with interest rates pretty high, you can get a 5% return for essentially no risk, so why not take it? But if you asked me this 4 years ago, I would have said no, you'd get like 1 or 2% returns. Probably not worth it. All right, we're heating up. For the next 10%, I'd buy specific stocks, ideally blue chip stocks. My stock portfolio right now is extremely simple and nothing special. I hold a few big dogs like Google and Apple, but the reason why you want high market cap stocks is they're just much more stable over long periods, which just fits with your long-term plan. Again, we are building the defense right now. We're not trying to get insane returns. Now, depending on the state of the market and how much free time you have, I'd also potentially tell you to look into smaller value stocks. Smaller meaning like still billion-dollar companies, but not like Google size. Value stock investing is essentially scoping out stocks that the market is undervaluing because they either produce a lot of cash or they have valuable assets that are simply mispriced by the market. Something where you can look at it and it's priced at $1 and you're like, I think that should be priced at $2. That's a value stock. This takes some time to be able to identify these, and some markets are just far better than others to serve up these opportunities for value stocks. For example, when the market crashed for a few months during the pandemic, I scooped up 5 different stocks. They were obvious value plays based on how much profits that they were earning, but the prices just tanked on everything. So I bought these 5 stocks. My average return a year later was about 80%. It was just easy money because I could look at the market, I could identify just valuable companies and go, these aren't priced right, I bought them. That's not always the case. Sometimes it takes more hunting. Now, another potential strategy you can use to get ideas on this is simply looking at what the experts are buying. Whalewisdom.com lets you dig into positions of hedge funds and investors all around the world. This allows you to leverage the skills of experienced investors who regularly outperform the market. Now, obviously, you should do your own research first and never blindly copy someone's investments, but this gives you some really interesting insights. For example, Bill Gates. He has a lot of money in waste management, a boring company that gets rid of trash. But what's the bet that they'll be doing that in 20 years? Pretty high. So that's everything outside of crypto that you want to be doing. Overall, you should be looking like this. Again, we're doing this on purpose. That's the vast majority of your portfolio allocated to defense. I know that it looks like a lot, but ask yourself, are you willing to lose the vast majority of your money? Or do you want to secure and grow what you've earned? Yeah. So build a defensive portfolio that'll keep your money safe. Now, the remaining 10%. That's a little bit of a different story. This is where you can be a bit degenerate if you so please. Enter crypto. For crypto, you have a wide variety of options. Because you've secured almost all of your money in defensive investments, you can go pretty wild with the last 10%. Here's an approach that you might like. I'm going to take 8% of my remaining 10% and allocate that to a variety of coins. The remaining 2%, you'll see what I'm doing with that in a second. My main holding, it'll be Bitcoin. 50% of my coin allocation, or 4% of the total portfolio. Again, because we're investing 8% of the total portfolio into cryptos, half of that into Bitcoin. There's 5 reasons why I prefer holding so much Bitcoin. Number 1, Bitcoin has by far the highest market value of all cryptos, as well as the highest trading volume, meaning it's stable for a crypto. Number 2, Bitcoin is pairing liquidity with essentially the entire market. Almost every major coin has a trading pair with Bitcoin. Number 3, we're in a pretty volatile time right now. I mean, I can see a lot of people pulling money out of the market and sticking it into Bitcoin if things get more and more volatile. So I want to be ready if that happens so I can capture that upside. Number 4, from my experience, Bitcoin has made me more money than any other crypto investment. Number 5, Bitcoin outperforms everything. Now, as much as I want to stick all of my money into meme coins, I can't sleep on the facts. Bitcoin performs, so it gets my money. It's still volatile. It's a crypto, but its relative stability compared to other cryptos balances out my next choices. For the remaining 50% of my coin allocation, I'll break that down into high-risk meme coins and mid-caps. The sole goal here is to capture pumps. If I lose money, I'm not happy, but it's fine. If crypto magic happens, I might grab myself a 5, 10, 15x return. That's what I want to expose myself to. In general, I want to look for projects with a few fundamentals. A solid use case that's immediately relevant, like the crypto render. They help with video graphics and rendering. A solid team with big ideas and a community that gets attention, like Snek, who dominates Cardano's Twitter. And a solid list of ties to other projects, big name companies, or media related to its activities, like Arkham, giving data on everyone from Andrew Tate to Donald Trump. I would also focus on cryptos within your circle of competence. If you're chronically online, deeply tied into crypto culture and Twitter, this will probably mean meme coins. If you're into tech, AI developments, and data, then AI cryptos are probably the best thing for you. The same logic goes for gaming. Invest in what you understand and you will just make more money. But again, because of how defensive your portfolio is, you can afford to be a lot more reckless here if you want to. Again, you don't have to be reckless, but if you want to be reckless, go ahead. So that's 8% of my total portfolio allocated to high risk, with 4% allocated to extremely high risk. If it crashes and burns, I'm fine. But if it catches a big pump, I get massive returns. Now, what about that 2% of my portfolio? The 2% goes to trading. My goal here is to profit from moment-to-moment price swings as they happen. This is not for the faint of heart, but if you want to unfuck your portfolio and you have the mentality for it, and you have some time to look at charts, you might want to look at adding this in. If you have enough patience to only make a trade when all of your trading rules are met, you can have quite a high success rate with this part of your portfolio. So you've got a portfolio that looks like this. From here, you can compare it to your current portfolio and start moving money around until it matches this. Or you can start from scratch and begin dividing your money up by percentages. It doesn't matter whether you're investing $10,000 or $100, percentages work, so you can just start with that today. Then you can just keep buying into your portfolio, keep dollar cost averaging into each level of it. Cash, ETFs, bonds, stocks, cryptos, and trades. Growing your money day by day, each part keeps the other secure. Remember, defense. Defense is the goal here. If you're consistent and manage risk accordingly, you'll outcompete 9 out of 10 people, probably more, but there is a catch. You are not me, and I am not you. You might want more risk. So here's some more options. This portfolio cuts defensiveness for stock allocation and crypto. This would give you a lot more money to play with in crypto, but bear in mind that's 30% of your money exposed to crypto and growth stock volatility. There also is this style, which could be an option if you enjoy the chaos of trading. Because trading is so risky, you're balancing it out with extremely low risk bonds. 15% is a huge amount of risk, and I wouldn't recommend it, but 55% of your money is secure in bonds, which is good insurance. Or for a more crypto-focused portfolio. Again, extremely high risk, but you're hoping the allocation of bonds, Bitcoin, and mid-caps help balance out that risk. Approach this one with caution, please. This should help you tweak the portfolios to meet your needs. But to see how to pull off the trading portion of your portfolio, check out this video here where we explain a foolproof strategy step by step.